I think you really need to stay invested right now. We are not seeing any recession in sight whatsoever until at least mid-2020. And the thing is, recessions and bear markets typically require an earnings contraction, not just a deceleration. And that's all we've seen so far. You know, the latter stages of bull markets are, they're always going to be jittery, but the performance improves enough so that you can actually get some pretty good, some pretty attractive risk-adjusted returns. Now, there have been 9 bull markets since the 1960s, and if you were to go through and break down each and every one of those bull markets into deciles or tenths, the average annualized performance of each decile is 20%. Now, there's only 2 deciles that actually outperform that average. The first one is the first decile. That is the best performing decile, and that's kind of self-explanatory because you're coming out of a bear market with an annualized return of over 60%. The second best performing decile is the last decile with an annualized return of almost 40%. So if you decide to leave the party early, you're going to miss the grand finale, and you don't want to do that.
First off, you said decile 7 times. The under-over was 2.5, Mark. I mean, it was like the Steelers score last night. I am shocked by the number of times. Put $1 in the decile jar. We'll go out drinking. Okay, so what you're saying is that effectively, if we just kind of get the average, or even not even, maybe even the lower side of the historical average, it's still pretty darn good.
Yes, you don't want to bail early. You leave the party early, you miss the grand finale. I think it's okay to leave during the grand finale and get ahead of the traffic on the way home, but you don't want to miss it because the market typically ends a bull market with a boom. And I've heard a lot of people talking recently about potentially downshifting their equity exposure, raising cash, shifting more into bonds and stuff like that. And quite frankly, it just doesn't make sense because there's nothing we're seeing right now that leads us to believe that we are going to enter a bear market and definitely not a recession. I mean, we're still experiencing earnings growth. We're looking at like 24% earnings growth year over year. We're projecting somewhere probably just below 10% for next year. So as long as we're experiencing earnings growth, the market should continue to advance. Now, at this stage of the game, typically what you see is earnings continue to grow and multiples continue to contract a little bit. So if earnings do grow at 10% next year, maybe we only see a 7% gain in the market.
I love the historical reference. I love history. Okay, and I hope you're right because we've all got 401ks and 529s and whatever here. But you got to also consider that A, we're in a rising rate environment. B, the Fed is delevering, something we've never had a combination of. And C, you've got what can only be termed as a very unusual political situation in Washington, D.C. I do wonder how much history may not be followed this time.
Yeah, so unfortunately, I got to throw some more history at you here. But, typically the direction of interest rates with regards to the Fed funds rate and also the movement of the stock market are positively correlated until the 10-year Treasury hits right around 4%, and then it can invert. So right now we're at 3.2, so we are comfortable with the market continuing to raise rates. And again, some research has also told us that when you look historically, the market can typically withstand an increase in that 10-year yield of about 1% over the course of a year before it hurts the equity market. So our low has been 2.7, so we feel like it can go all the way up to 3.7 before it starts to hurt stock prices.